Welcome back to the Daily Crypto Roundup. Today's session comes at a moment where crypto markets are holding together better than many expected, despite a growing list of macro, political, and regulatory uncertainties hanging over the global economy. This hasn't been a euphoric day, but it hasn't been a panic either. Instead, markets have moved with hesitation, reacting selectively to headlines while trying to avoid committing too far in either direction. When we look beyond the headlines and check how the market's largest coins are actually trading right now, we see a picture of stability rather than chaos. Bitcoin is holding around about $90,900, a level that's acted as a kind of structural anchor over recent sessions, and suggests buyers are defending key support. Ethereum is trading near $3,110, maintaining its position as the number 2 asset and showing more resilience than short-term price moves might imply. The big stablecoins are behaving as expected, with Tether and USD Coin both hovering right around $1, keeping liquidity flowing across exchanges and markets. XRP is sitting around $2.10, drawing continued interest as capital rotates within the crypto space. BNB remains near $915, reflecting strength in the exchange and ecosystem token category, while Solana is around $137, holding its own amid broader market caution. Other large-cap coins like Tron at about 30 cents and Dogecoin near 14 cents are similarly range-bound, showing that major cap sentiment is cautious, but not fearful. Even Cardano near 39 cents is reflecting the same sideways consolidation that's defining this part of the cycle. Overall, the top of the market looks like it's digesting recent events, not panicking, and price behavior across these key coins reflects a market that's pausing and watching, rather than exiting. One of the key sources of uncertainty today has come from the United States Supreme Court, which is expected to issue an opinion on global tariff policy. While this isn't a crypto-specific ruling, its implications stretch across financial markets. Tariffs feed directly into inflation expectations, supply chains, and corporate margins. When markets don't know whether trade barriers are about to tighten or loosen, risk appetite naturally pulls back. Crypto has reacted in line with other risk assets here. There hasn't been a sharp sell-off, but there also hasn't been a rush to add exposure. Instead, markets have remained range-bound, waiting for clarity. This kind of macro overhang tends to suppress volatility temporarily, even as underlying tension builds. Regulatory pressure also featured prominently in today's news, particularly out of India. The country's Financial Intelligence Unit announced tighter KYC and AML requirements for crypto users, including live selfie verification and geotagging. This represents another step in India's increasingly strict approach to crypto oversight. For markets, the significance here isn't limited to India alone. It reinforces a broader global trend. Regulators are no longer debating whether crypto should be monitored. They are refining how it should be monitored. Enhanced identity checks raise compliance costs and friction for users, but they also reduce ambiguity for platforms that want to operate legally at scale. This kind of regulatory tightening doesn't usually trigger immediate price moves. Instead, it slowly reshapes where liquidity flows and which platforms gain or lose relevance over time. On the market structure side, commentary from Dubai-based crypto analysts today reflected a similar theme. Analysts stressed that crypto in 2026 is unlikely to reward luck or reckless speculation. Instead, they argued that disciplined strategies, risk management, and patience are becoming increasingly important as the market matures. This kind of messaging would have sounded out of place a few years ago, but today it aligns closely with what we're seeing in price behavior. Volatility still exists, but it's more selective. Markets are punishing overextension faster and rewarding caution more consistently. Bitcoin's price action today reinforces that point. Despite mixed intraday movement, Bitcoin has managed to remain above $91,000, avoiding the kind of sharp breakdowns that characterized earlier cycles. This stability doesn't guarantee upside, but it does suggest that sellers are not in control. At the same time, institutional flow data continues to send mixed signals. New figures show that XRP-linked exchange-traded products have hit record weekly volumes, even as Bitcoin and Ethereum ETFs have experienced combined outflows. This divergence is notable. It suggests that capital is rotating rather than exiting the space entirely. While some investors are reducing exposure to the largest assets, others are reallocating toward narratives or structures they believe offer better risk-reward profiles in the current environment. XRP's continued visibility today reflects this dynamic. Media coverage and analyst commentary have framed XRP as a standout trade early in 2026, drawing attention even during relatively calm market conditions. This doesn't automatically translate into sustained gains, but it does keep XRP firmly in the narrative, and narrative persistence matters. Broader crypto markets have also felt the effects of profit-taking today. After recent gains, traders have been locking in profits, leading to modest pullbacks across Bitcoin, Ethereum, and XRP at various points during the session. Importantly, these moves have not been disorderly. Volume has remained manageable, and there's been no sign of forced selling. This kind of behavior is typical during consolidation phases. Markets pause, reassess, and redistribute positions without collapsing. It's often during these quieter periods that longer-term trends begin to take shape. Institutional developments added another layer to today's picture. Reports highlighted that major financial firms, including Morgan Stanley, are continuing to explore or enter the crypto ETF space. While this wasn't a standalone announcement today, it reinforces the ongoing institutionalization of crypto markets. Large banks don't move quickly, and they don't chase short-term price action. Their involvement tends to be incremental, driven by client demand, regulatory clarity, and long-term strategy rather than momentum. Macro data expectations also weighed on sentiment today. Traders are watching upcoming U.S. jobs data closely, alongside developments around tariff policy. Both factors influence interest rate expectations, which remain one of the most important drivers of crypto prices in the current cycle. Bitcoin's sensitivity to macro data has increased over time. It no longer trades purely on internal crypto narratives. Instead, it responds to the same economic signals that move equities, bonds, and currencies. Today's cautious tone reflects that integration. Despite all of this, early 2026 has still delivered a rebound relative to the end of last year. Capital inflows have returned selectively, lifting sentiment without pushing markets into excess. This measured recovery is very different from the explosive rallies of previous cycles, and that difference is important. What today's headlines collectively show is a market that is maturing in real time. Regulation is tightening, but becoming clearer. Institutional participation is expanding, but cautiously. Traders are active, but restrained. There is no single catalyst driving crypto right now. Instead, price action is being shaped by the interaction of policy, regulation, macro data, and capital rotation. Another important layer to today's market behavior is how traders are responding to uncertainty itself. What stands out is not what markets are doing, but what they're refusing to do. Despite a heavy calendar of macro risk, regulatory tightening, and mixed institutional flows, there has been no broad rush to the exits. That restraint suggests that a large portion of speculative excess has already been removed from the system. In earlier cycles, this kind of headline mix would have triggered sharp emotional reactions. Today, it's producing caution instead of chaos. This is particularly visible in how Bitcoin is trading around key psychological levels. Holding above $90,000 may not sound dramatic, but it matters. Levels like this act as behavioral anchors. When price holds above them during periods of uncertainty, it signals that buyers are willing to step in gradually rather than waiting for capitulation. That doesn't guarantee upside, but it does reduce the probability of sudden breakdowns without a clear catalyst. The contrast between ETF outflows in Bitcoin and Ethereum and record activity in XRP-linked products also deserves a bit more attention. This isn't simply a story of money leaving crypto. It's a story of selective allocation. Investors are making decisions about where they believe regulatory clarity, narrative momentum, or structural advantage may exist. That kind of rotation is more typical of mature markets than speculative ones, and it reinforces the idea that capital is becoming more discerning rather than more fearful. At the same time, regulatory developments like India's tighter KYC and AML rules are quietly reshaping the user landscape. Measures such as live selfie verification and geotagging introduce friction, but they also signal permanence. Governments don't invest in refining regulatory frameworks for sectors they expect to disappear. Instead, they build controls around industries they believe will persist. For long-term participants, that distinction matters far more than short-term inconvenience. This theme of discipline over excess has also been echoed in commentary coming out of major financial hubs like Dubai. Analysts emphasizing strategy and risk management over luck are effectively acknowledging that the easy gains phase is behind us. Crypto is entering a period where returns are more likely to be earned through patience, positioning, and understanding market structure rather than chasing momentum. Macro uncertainty continues to sit at the center of this balancing act. Tariff policy, jobs data, and inflation expectations remain unresolved, and markets are keenly aware that any one of these could shift sentiment quickly. Yet the absence of panic suggests that traders are waiting for confirmation, rather than reacting preemptively. That kind of behavior often precedes larger moves, not because markets are complacent, but because they're conserving optionality. Institutional involvement adds another stabilizing force. The continued exploration of crypto ETFs by major banks signals that large players are still building exposure pathways, even as short-term flows fluctuate. Institutions tend to operate on longer timelines. They are less concerned with daily price swings and more focused on infrastructure, compliance, and client demand. Their presence doesn't eliminate volatility, but it does change its character. As we head toward the next trading sessions, the focus will remain on confirmation. Confirmation from policymakers, confirmation from macro data, and confirmation from capital flows. Until those signals become clearer, hesitation is likely to persist. And that hesitation, in itself, may be the most important signal of all. This is not a market bracing for collapse. It's a market waiting for clarity. As we move into the next session, the key questions remain unresolved. Will tariff uncertainty clear or escalate? Will macro data confirm or challenge current expectations? Will capital continue rotating within crypto or step back entirely? For now, the market is choosing patience. Drop your thoughts in the comments, smash like, follow for the next update, and until the next time, we will see you at the top.